now it's time for Charting Futures. Here's Abigail Doolittle. And Abigail, I see you're keeping us simple today and looking at good old-fashioned stocks and bonds.
You're right about that, Romaine, because it's a true risk-on day, an old-fashioned risk-on day. Let's take a look at the S&P 500 and the 10-year yield, and we will see that stocks are sharply higher, up 1.3%. The S&P 500 up for a third day in a row. The last 2 days, the best since early June. And while this is happening, we actually have haven bonds pulling back. Take a look at that 10-year yield at 1.6%, up 5 basis points. Of course, price trades inverse to yield, but this is an unusual day because 2019 has been all about stocks and bonds rallying together. Come into the Bloomberg and take a look at this chart that we have here. In blue, we're looking at the 10-year yield. In white, we're looking at the S&P 500. And we can see earlier this year on what was called the Powell Pause, the 10-year yield did drift lower, stock sharply higher. There was a little bit of a pause there, but then yields started to keep going lower. On that, the S&P 500 climbed. But there was a point where stocks really couldn't take yields going any lower, and that was 2% after the Fed's last meeting on July 31st. You see that the 10-year yield absolutely took a nosedive below 2% to its lowest level since 2016. On this, we have this massive range for the S&P 500 at one point down somewhat sharply, now down just about 1.5% for the month of August. To talk more about that range and what all of this means, I'd like to bring in Greg Calderone of Bloomberg. Thanks so much for joining us for Charting Futures. And what do you think about that near-term range for the S&P 500? What way do you think it resolves? And also bring rates into the equation.
Sure, Abigail. So if you look at the latest range, really, we're kind of peaking out at about 3,000, where the S&P has seen some resistance, and we bottomed out right around 2,850. So just in the last kind of few weeks here, where we've had that sell-off in rates, what people have done is, within that range, they look at multiples on the S&P 500.
Okay.
So right now, next year's earning estimates are about $178 per share on the S&P. That gets you to, at 16 times, with the lower rate, you get a about 28.50 price target, which is that yellow line on the chart there. At 17 times, which would be the higher end of the multiple range, you have that earnings estimate coming in at about a $3,000 price target, which is where we see some resistance just before the sell-off in rates.
Okay, and if rates were to continue to fall, that would suggest even a lower multiple, that maybe that bottom would fall out. Is that true? Or is that one reason why stocks have been so sensitive once below 2%? It's just too much?
Somewhat true, yes. The macro guys have started to kind of really take hold of the market after earnings season has started to peter out here. So with everything that's going on over the next couple of weeks and even into the end of September, when we have the next Fed rate meeting, we actually have a risk reversal on the S&P 500 futures, or the mini futures, which is about 150 the S&P 500, that we can put up here on the board that'll indicate really just trying to capture some premium in that volatility. Mm-hmm. So what this gives us is about a 5% range on the major index. And we don't expect, based on those 16 and 17 times multiples, the market to really trade outside of that range.
Okay, so really take us through this options trade, because this is something a lot of people don't realize, that you can actually trade options on futures and thereby limit some of the capital that you're outlaying.
Sure. So again, we'd be selling a 3,000 upside call and a 2,850 downside put for about 46 total. Okay, $46 a contract total. Again, that captures that 5% range, mm-hmm. And gets you right through the end of expiration in September, which is a couple of days after the next FOMC meeting.